International analysts have called out the supposed use of the national security policy of the U.S. as a tool to justify the establishment of blockades and economic sanctions against countries like China and Russia. While U.S. Treasury Secretary Janet Yellen has recognized that a decoupling of the economies of the U.S. and China would be disastrous, the U.S. government is said to be putting its security policies over this concern. American analysts are also voicing their concerns. Gary Huffbauer, senior fellow at the Washington-based Peterson Institute for International Economics, PIIE, explained that these measures went beyond the reasonable scope of national
company. Thanks so much for being here. Western Alliance really stands out to me. That's one of the ones that we've heard from. We heard from them last night, and they said deposits were up $2 billion this month through April 14th, which certainly investors are seeing as reassuring. Is everything okay with regional banks? Is that one of the things that we can perhaps take away from Western Alliance?
Sure. Thanks for having me back, Julie. So Western Alliance is one of these banks that's been caught up in some of the drama since March 9th, since SVB, right? So they are a high growth company that has done really well over the cycles, but there's been a lot of uncertainty on their deposits. And so they told us about a week ago that deposits were going to be down about $6 billion. We got validation of that last night. But they've also told us that deposits are up about $2 billion in the first 2 weeks of the quarter in Q2. So that's, I think, a really important data point. And that, I think, investors, based on the stock up almost 20% today, that is them telling us that they are distancing themselves from the crisis that was 5 weeks ago.
Yeah, and I guess that's my point. If this company, which really was, if not at the center, was in one of the close concentric circles of the Silicon Valley Bank concern, if this one is doing okay, can we extrapolate that the sector writ large is on the same footing and is recovering?
Right. So Western Alliance was, I would describe as guilt by association. So they were a high growth company with a lot of commercial deposits that was really caught up in the SVB, the Signature, the First Republic. We thought, and we've thought all along, this one's a little bit different and people needed to do the work. And so what they've proven is that their business model is very flexible. Their balance sheet is very nimble. They are able to flex up and down as they see fit. And what they're doing today is they're prioritizing capital, they're prioritizing liquidity. And at the same time, they're still blessing the earnings estimates that are out there. So Western Alliance is a special situation. We feel even better about that after seeing the results. Now, more broadly on the group, the group has really been soft all year. And that's really because of the narrative that earnings had peaked, right? We went into this year and we downgraded the sector to market weight in December. Our call was really, we were at peak earnings and multiples, while cheap, we're going to struggle to re-rate. We've seen validation that earnings have peaked. You've seen earnings have come down into the quarter. We're seeing earnings come down for a lot of banks after the quarter. But broadly, the industry is very healthy. It's just a matter of level of profitability.
You had Morgan Stanley's CEO saying on their conference call this morning, Chris, that we are not in a banking crisis. Is the banking crisis over?
Yeah, I think we still need resolution from a few of these special situations, right? First Republic's been a name that's been in the press. We all know what's going on there. That still is out there. They're set to report earnings next week. That'll be an important data point. But in general, I agree. This is a very contained crisis, if you will. The industry is in a very good spot from a health and capital and regulation, for the most part, has worked. But we do need to see resolution for a few of these larger institutions that are a little bit more stressed.
So, Chris, as we start to get more of the numbers, we're sort of, I don't know, we're not quite 50%, I guess, when it comes to the regionals. But what do you think are, it sounds like you like Western Alliance. What are some of the other ones that you think are going to fare better in this environment?
Yeah, that's a great one. I think you got to be careful. I think you got to pick your spots. Two names that we upgraded during really this crisis over the last month. New York Community Bank, which we've talked about vocally, the stock's trading below tangible book value. They did a very accretive acquisition with Signature Bank, right? 20% accretion to earnings, 15% accretion to tangible book, no capital raise, trading below book with a 7% yield. That's a special situation. We really like New York Community. The other one that we upgraded about a week ago was Columbia Bank out of the West Coast. Again, the company went through a transformational merger that closed at the end of February. It's trading below forward tangible book value. Their balance sheet is marked, so they have more flexibility strong yield. And again, expectations for this company are pretty low. So we like those two special situations.
More broadly, what factors make a bank investable right now following the turmoil that ensued in mid-March?
Banking's about confidence, right? We've seen that from March. We saw deposits leave the industry and move out of some of these largest banks. So confidence is a huge component to really getting confident into investing into a bank stock. So again, we need to see some resolution from the likes of like a First Republic. But in terms of where we are in the cycle, banks are cyclical. So we are late cycle. Whether we're going to have a hard or soft landing, that can be debated. But in general, there's a lack of sentiment and there's a lack of aptitude to really go overweight financials and balance sheet financials right now because we are late. So, in my 20-year career at KBW, you make money. You make a lot of money in times where there's a lot of stress. You go back to 2008, the March 2009 bottoms. That was a really good opportunity. The COVID bottoms, that was a great opportunity. We don't get a lot of them, and we may have one right now. But again, we got to get through some of these near-term issues.
I asked which ones you like the best. I also want to ask which ones you think people should avoid. As we try to get through these near-term issues, you talked about where people can sort of ride it out. Where should they not be riding it out stock-wise?
Right. I think you got to tread carefully on commercial real estate. Right. That's a huge asset class and it's very diverse. But we've seen a lot of headlines about office real estate. The work from home, the return to office dynamic, that's a headwind that's going to plague more of the small banks than the largest banks. They're more concentrated, the smaller cap you go. So you got to be careful on companies that have a lot of office exposure, a lot of metro exposure. And generally you want to own, in this time of situation, you want to own really good management teams with really strong balance sheets and where we think the management teams can deliver.
Christopher McGrady, who is the KBW head of U.S. Bank Research. Chris,